Hello, everyone. Today on the final bar, I don't know if I can call this Recovery Friday, but certainly a V or U-shaped shape to the action today in the markets. The S&P, the Nasdaq selling off pretty aggressively through the course of the morning. Mid-afternoon, we make a big left turn and pop back to the upside. The S&P finishing right at 3,900. What does that do to this overall bearish thesis we've been talking about? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the technical analysis toolkit to better understand what's happening around us. As I've worked with my premium members at Market Misbehaviors, I've worked with our viewers and individual investors and financial advisors and others earlier in my career. It's all about, I think, improving your market awareness. A lot of times we're caught off guard by the movements. We're surprised by how things are playing out. At the end of the day, you want to have a good understanding of what's happening around you. I think charts, better than any tool you could bring to bear in this market environment, help you understand what's happening, help you really understand the investment landscape, understand themes as they evolve. Pay attention to what people are excited about, nervous about, desperate about, euphoric about. The charts arguably will tell us all of that and more. And here on a Friday, we do a wrap the week session, which we will launch into a little later this morning or this afternoon, and focus on how the markets have evolved from last Friday to this Friday. And now we have great guests on this show. We had a great conversation yesterday with Louis Llanes. If you missed that one, I'd go to stockchartstv.com or on our YouTube channel. It was really interesting. An aggressive downside target on the SP around 2850, if I remember right. Other great guests we have coming up on the show. Let's talk through it. So next week on the 24th, we have John Kosar from Asbury Research. The week after Memorial Day holiday, then we have Dave Landry on June 1st. On June 2nd, we have Jay Pettit joining us once again on the show. Let's continue on today's show and wrap this week. Let's focus on how the markets have evolved. It has been a crazy week. Usually on Friday's show, I have no shortage of things to talk about, particularly on a week like this. There's so many movements to try to unpack: earnings, big picture movements, and et cetera. Before we go there, though, I do want to briefly address a poll. We always have a poll running on our Stock Charts live stream page at stockcharts.com. Also through our social media accounts. So make sure you follow us on Twitter, on Facebook, on LinkedIn, wherever you do your social stuff. Follow us there. Which ETF, we asked you, performs best over the next 3 months? A little forward-looking idea. 69%, almost 7 out of 10 of you said oil and gas, $XOP, which is an oil and gas index. Gold was second with 15% of respondents. After that, it was mixed between clean energy, ICLN, and FANG stocks, $FNGS. Now, to be honest with you, I probably would agree with that one. 3 months is tough, right? Because 3 months could mean a lot of things. And that's why this is a tough one to answer. When you look 3 months out, a lot can happen, right? We could have a very clear bottom. I would not say today's action in the market you can declare it a clear bottom. You certainly can declare a nice rally going into the close. That's nice, a nice way to finish the week. But overall, I think there's still a lot of ominous signs out there. So clean energy, you would have to buy into a bullish reversal of sorts for the market. Same with FANG stocks, right? FANG stocks in general are in a pretty established uptrend. So the character of the market would have to look very different. And what concerns me is the ability of either of those groups to do well if rates continue to go higher, which all indications would suggest are the case. Now, GDX is an interesting one. And you think about, gold miners, think about silver, think about other mining stocks. These are names that at times have looked sort of compelling. And I remember in March to April, we're looking at the chart of the GDX, looking at Newmont Mining, Rand Gold, other mining names, Rio Tinto, and seeing these nice rotations to the upside. they've given back all of those gains. Now, part of that is the stronger dollar, just the way that inflation is sort of played out, and so forth. So gold necessarily has not been a great bet over the last 6 to 8 weeks. Now, what's interesting on the GDX is we're now testing the lower end of that range. So if you buy into gold here, you're basically assuming we're at the weaker end of this big 2-year range, and most likely we have a mean reversion to the upside. That leads us to what 2 out of 3 of you said is the best opportunity here, oil and gas. And I'd have to agree, only because my sort of general take on the market a couple of months out probably assumes higher commodity prices, probably assumes higher crude oil prices. And again, a lot can happen and we'd adjust as needed. But most likely that involves energy stocks still kind of working, particularly on a relative basis. The relative strength in energy has been so impressive. If and when that changes, maybe the responses to that poll change. But so far, I would have to agree with Final Bar Nation on the take there. Let us wrap the week. So what I'm going to do next is look at our wrap the week chart. We have a set of charts that we look at just on Friday's show. We're going to start with this one, which is looking at the major asset classes, how they've evolved from last Friday's close, which is on the left side of the chart, and going through today. So quite a lot of movement, as you can see. Let's start with the S&P 500, which is here, finished the week down 3% as of the close. Only one of the things on our list here underperformed the S&P. That was the NASDAQ 100. The Qs, which were down 4.4%. Everything else outperformed the S&P this week. We have the US dollar, the UUP, which was down 1.5%, down 1%, the Russell 2000 ETF, the IWM. Everything else was in the positive. In brown, we have crude oil prices using the USO, which is up about 0.5%. We have the emerging markets, which were up 1.7%. Gold, the GLD, which was up almost 2%, and 2.2%, the best performer. Bond prices. Now, that's been interesting because, right, part of I think the overall story in 2022, if you summarize it, it's weaker risk assets, particularly weaker stocks, weaker cryptocurrencies, really flat to lower gold, weaker bond prices, higher rates, and so forth, and then higher crude oil prices, higher commodity prices. And if you look at what's happened here, this is potentially a bit of a change. The stronger dollar has been part of that, obviously, as well. This week, you get a bit of a reversal, right? So instead of stronger dollar, we have the dollar weakening a little bit. Instead of weaker bond prices, we actually have bond prices rallying a little bit. That could be that indication of sort of I hesitate to use the phrase, the puke out phase of the market. So I'll come up with the capitulation phase, we'll call it, right? Which is that ultimate, no one can imagine buying stocks because everyone goes to risk off fetal position mode, which means you're buying T-bills and just really conservative stuff. That's not necessarily happened, right? We've seen bond prices going lower. We've seen energy stocks and industrials and materials working. That starts to end, and you see energy stocks coming off because people can't even buy into that idea of owning any sort of risk asset, and we get really defensive. That might be that indication that we're entering into that acceptance phase of the downtrend. So it might be something really important, certainly is, to watch going into next week. Bitcoin, if we add it to the mix, actually ended up unchanged for the week. How's that possible? From last Friday to this Friday, everything else is chopping all around, and Bitcoin certainly did, but Bitcoin essentially unchanged for the last 7 days, from last Friday's close to this Friday's close. I actually didn't believe that when I first looked at that before the show today. Just to finish off very briefly on what happened today. So you had this big rally going into the close, the S&P getting up to 3,900. We're going to go to a chart of the S&P here in a few moments, but I did want to highlight that on today's action, by the end of the day, you sort of had the barbells. On the upper end, you had healthcare and real estate, both up over 1%, followed by energy. On the bottom, consumer discretionary by far the worst performer. If you look at the stocks that were down today, things like Ross Stores just completing this butchering of retail stocks in this week. Dollar Tree down 6%, AZO down over 6%, Tesla coming down as well, Dollar General, Advanced Auto Parts. So it's sort of all in these similar buckets. But then also John Deere, which is sort of a tough one, right? This is a chart that, again, early mid-April, looking pretty compelling, where you have this resistance around, we'll call it 390, 380, 390. We test that resistance a number of times through 2021. We finally break out to a new swing high in March. We double down and make a new all-time high there in April. And that was it. From there, we've now broken both moving averages. We've failed to hold support levels. We're making lower lows and lower highs. And today's gap puts us below a significant support level. This is the low from June of last year, from October of last year, really February of this year. We've now closed below it. So a big down day for Deere. I would be watching that going into next week to see if buyers are coming in and buying in on the weakness going into the new week, or if we get a follow through day, we get validation of a breakdown. Charts like Deere breaking down after looking so good not too long ago could be, again, part of that evolution to more of a bearish environment, more broadly speaking. We finish off the Wrap the Week segment here, taking a few minutes to look at the Mindful Investor live chart list. So as a reminder, this is a list of charts that I keep updated at StockCharts.com. Go to the articles page, my homepage, which is called the Mindful Investor, and you can get to this list of charts at any time. No change on my market trend model. So on 3 timeframes, long-term, medium-term, short-term, is very much a negative trend to the market. So even with the bounce on Friday, it's worth noting the weekly closes have been down. So for the last, 8 weeks, every week we've had a lower close. And one of my mentors, Jeff Weiss, who was on the show last week before, if I remember right, taught me to wait for Friday's close. When you're doing long-term analysis, don't get too excited by intra-week movements. Wait for the weekly close, wait for the monthly closes. That tells you over time. That's a good gauge of how the market is evolving. During the week, a lot of noise can happen. And even if the rally today, it's worth noting, we're still closing lower, right? So that pattern changes, and I stop being so less than optimistic about the trend in the markets. The medium-term time frame, as a reminder, for me is sort of looking at a month or two, and that's sort of my main time frame that I pay attention to. It's been risk off pretty much most of 2022, and certainly remains so here. What's happening with the rally today? So I don't know. Again, I'm not. I'd love to tell you that at any given moment I can get inside the heads of all other investors, big institutions, and other players, and tell you exactly what's happening. A lot of times it's educated guesswork on what we're seeing. One of the things we've talked about on the show for a while now, for a couple months, is this 3,800 level, right? This is a 38.2% retracement of March 2020 to January 2022. Many of us in the industry have keyed in on that level because it's such a clearly defined low from 2020, a clearly defined high from earlier this year. And so 38.2% is right at 3,800, which means when we get within a rounding error of it, which we did today, you would absolutely expect buyers to come in. I would be blown away if buyers did not come in, assuming that there could be a bottom here. There's enough of a chance that there's a tradable bottom at 3,800 that people anticipate it and start to get into it. I think that's what's happening going into the close. You get people buying in and attempting to anticipate this move higher going into next week. Again, I'm not seeing any significant change on the broader indications. Breadth pictures still fairly negative. It's interesting to note that the S&P advanced decline line still has not made a new swing low. Is the only one of these 4 that has not undercut its March low. I would be looking for that as a further validation of the downtrend. Finally, I'll just finish off with this, and we need to take a quick break. 15% of the S&P members are above their 50-day moving average as of Thursday's close. I don't know if that's going to change a ton, given what we saw today, essentially a flat day at the end of the day. So that's pretty low relative to where it's been over the last couple of years. That is not the level that we've seen at the end of bear market phases. That indicator tends to get all the way down to 0. May not be the end yet. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down the activity in the markets from a technical perspective. If you use charts, if you're focusing on technical indicators and technical analysis as part of your process, we hope you find a home here at StockCharts TV because we have a lot of great content to help educate you and inspire you and inform you using the language of charting and technical analysis. Couple quick comments before we get to our next segment. First off, we welcome your questions. We're going to do a mailbag segment here in a few minutes. We're going to be featuring questions from viewers like you over the last couple of days, and we'd love to feature your question next week. We'll do another mailbag segment on Tuesday's show. and we would love to answer your question on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. Hope to hear from you and answer your question live on the air on Tuesday's show of next week. Also, go to stockchartstv.com. That is our on-demand platform. We have such great content and so many wonderful guests. Had fun talking with Louis Llanes and others this week. Our Ari Wald on Tuesday, just a fantastic long-term take on the market environment. Special events like The Pitch. Jay Woods did a great job hosting The Pitch this week. So much more, all for free at stockchartstv.com or on your mobile device. Just search for Stock Charts TV on demand. Our next segment is Power Up. What we love to do once a week is take a deeper look at the brief look, to be honest with you, at the Stock Charts platform, hit on one particular thing so you can power up your use of our platform, improve your use of technical analysis in your investment process. This actually came from a question we got to our help desk earlier this week, was asking about volume, right? How do I find up and down volume or advancing, declining volume on the S&P 500? What percent of volume on the S&P is up volume or is of advancers versus decliners? This is a technique that Paul Desmond, who was at Lowry's Research for a number of years before he passed away, unfortunately, a couple of years ago now, but a really thoughtful, knowledgeable market analyst who left a lot of great technical work in his wake as he departed. But overall, one of the things he talked about was looking at volume, right? Advancing volume versus total volume and making some conclusions about that. So how do you find something like that if you don't know how to do it on Stock Charts? I introduce you now on the upper right corner of our website, the little magnifying glass. This should be your friend if you're trying to find something like this. So if I type S&P volume, or I'm typing SPX volume, hit enter, what it's going to do is this shows you a bunch of different databases, essentially, that you can sort on. We always start with our support articles because answers that we send through our help desk are often stored there. And so these are common questions that we've received from other Stock Charts users. So it can be a great way to just see what types of things we've been telling other people. You can also use this feature to search on blog articles. Who's written about volume on the S&P? Tom Bowley, Carl Swenlin, Art Hill, whoever, all of those are keyword searchable there. Chart School is a great place to go as well, particularly if you're learning how to use technical analysis. Use our Chart School feature to understand it better. What we're going to do is go down to symbols. And now this shows you all the different symbols that are using those keywords. And again, you can just keep changing these keywords if it's not exactly what you're going to find. But we have a ton of data for breadth and other indicators, obviously mutual funds, equities, ETFs. And this is the way you can find all those particular symbols. So if I search for SPX volume, you will see these three indexes, exclamation point UVol SPX, DVol SPX, and TOVol SPX. So if you create a chart of the S&P 500, do a simple ratio, exclamation point UVOL SPX, a colon, the two dots, and then this other index, you will have the percent of up volume versus total volume. So use this magnifying glass in the upper right corner. That is the way I have learned to create a lot of cool charts using different breadth indicators. And we have so much great breadth data. Anything with an exclamation point are indicators, breadth indicators that our Stock Charts data team is creating by hand every day, every week. And so we have a lot of stuff that you might not find elsewhere. And this is a great way to see what is on the Stock Charts system. Our next segment is the Final Bar Mailbag. We so appreciate all of you writing in your questions. Those of you that write questions and share links with the particular charts that you're looking at are especially helpful because that allows us to directly answer the chart that you are looking at. Let's get to question number 1. If you go by ratio charts like stock to industry and industry to sector, then MU Micron is showing some strength even in a down market. But if you go by classic chart pattern, double top, then re-entry point is around $35. How to reconcile these two technical analysis signals, which are giving diverging views. And this is the chart that you shared with me. And I love this is a very Gaddis Rosy. That is not an adjective, but I just created it. A Gaddis Rose style chart where you're looking at these ratios at the top. He loves showing these comparisons, right? Of the ticker, the stock versus the benchmark, the sector versus the benchmark, the industry group versus the sector, and you're doing all these different combinations. So what this allows you to do is answer the question, is Micron the best stock within this group? Is this group the best group within this sector? Is this sector the best group within this within the overall market? And then all the other combinations that I did not just lay out here. That's what these ratios allow you to do. Now, the price chart itself, that's what you're trading. You don't buy and sell relative strength. You buy and sell the stock price. And that's why it's important to understand it. So how to reconcile these two? And so what you're basically saying is this is a huge head and shoulders top, big double top, for example. If you do the classic measurement and look at this range from 95-ish down to 65-ish, you do an equal rotation down. That gets you down to like 35-ish, which is sort of what you laid out. So here's the thing. In a down market, when it feels like everything is going down, and at this point, most things certainly have been, the relative strength is what's really going to help you differentiate. When everything's going down, focus on charts where the relative strength is improving, because what that tells you is these are stocks that are going down a lot less than the broader market. So what's showing relative strength right now? Well, things like energy, which are in a really good uptrend, which are actually going up on an absolute basis, but also things like utilities, which really in general aren't going up anymore. They're just not going down nearly as much as the broader market. So what this would allow you to do is understand the long-term implications of this double top pattern, but also focusing on charts where the relative strength is improving. Those are the names that are going to outperform in a down market. It's a great way to not lose as much as the broader indexes are and ride out bear market phases much more effectively. That's how you reconcile those two. Next question. Do all technical analysis tools work the same in foreign markets as they do in the U.S. markets? My understanding is that many tools such as RSI and MACD were developed for U.S. markets. Do they work the same in markets that move based on different underlying mechanisms? And you went on to ask about, are there foreign corollaries to things like the VIX, the AAII survey, et cetera? So the short answer is, a lot of indicators that we use it's sort of in the traditional technical toolkit, particularly the one we use in the West, were created by American, European analysts. However, there is actually a great amount of the technical toolkit that was popularized, really created in Japan. Things like candlestick charting came from Japan hundreds of years ago in the 1600s. They have evidence of rice traders that would actually use a simplistic form of candle charts to figure out when to buy or sell their rice at the market, I would assume. Ichimoku charting, the cloud charting that people like Katie Stockton and Mark Newton and others have shown on the show are a Japanese form of technical analysis. So in different parts of the world, certain techniques have been much more popular. That's less about the dynamics in the market, but more about the way that the financial industry has evolved. Traditionally, US, European, sort of Western investors and technical analysts have tended to share ideas because there's a lot of overlap between our industries. The Japanese Japanese financial industry, there's often been a language barrier, but I'm happy to tell you, having gotten to know some really effective and knowledgeable technical analysts in Japan over the years, that language barrier is not that bad. It's actually pretty great. What I'm really excited is getting to work more and more with investors and analysts in China, in mainland China, where actually there's been a great gap. There's not a lot of overlap between the financial industries. And as a result, we really haven't communicated a ton as experts, as peers in the industry. So I'm hoping that we get that opportunity over time. So any of you that are in that area of the world, I'd love anything you can do to help us, make better connections. That would be fantastic. So having said that, what can I tell you? So I have traveled pretty extensively around the world at times in my career. I will tell you, experiences in South America are probably most relevant to what you're saying. I know going to markets there, the problem is the markets are a little less liquid and certainly a lot less transparent. So in the US, we're very fortunate to have very transparent markets. You can see data on positioning. We have a lot of surveys where investors are telling you how they're positioned. We have options markets where a lot of other global markets do not. They don't have equity derivatives as developed as we do in the US. And similar things like RFDs and things in Europe, right? Equity derivative products. Not as well developed. And so we're very fortunate to have that sort of transparency. I would say when you get to other markets, particularly emerging markets, a lot less information about survey data just because they aren't around there. Hopefully over time, we get more and more of that. And I'm optimistic that we'll be able to do those sorts of things. So the answer is, I would say when you look at the US or developed European markets, you will get the most information you can, maybe Japan in that same bucket. From there, the more you get further away from that in terms of the development of the underlying exchanges, in terms of the how long the industry has been active, and so forth, the more transparent, the less transparent, the less information you'll be able to get. Final question. 3 weeks ago, I asked myself what made sense with all the uncertainty. And the only certainties I could think of were higher interest rates and continued natural gas shortages. So I invested in GAZ and TTT. And if you're not familiar, GAZ is a natural gas ETN. So something sort of like UNG is kind of how I would probably think of that. And TTT, which is basically a short Treasury ETF. So a bet on higher rates. They have since proven my thinking to be misguided. Where do I go wrong? So it's really interesting. You asked this question just about the last month, essentially about the month of May, and you have this idea. And I would say your general perspective, what you're describing, which is, natural gas shortages and upside for commodities, higher interest rates and the activity of the Fed. Those are absolutely long-term things that I would agree with you. I think those are absolutely what we will be struggling with through the course of 2022. I think what you're running into is a time frame, incompatible time frames. You're evaluating, you're measuring yourself. Your report card is a couple weeks long, but your perspective is like a couple months plus. So you could find the path from point A, where we're at right now, and point B, which is higher commodities and higher interest rates. There can be a lot of movement between point A and point B. And I think you're going through this choppy period right now where the equity markets are rolling over. Everything is kind of getting crazy. There's a lot of choppiness, a lot of volatility. You may end up being correct. But I would say use short-term data to make short-term decisions, use long-term data to make long-term decisions. I think you may be in the right place for the long-term trends, but remember, the short-term doesn't care what your long-term thesis is. It can be more about the fear and greed that is manifesting itself day to day. So maybe focus on shorter-term charts. If you're looking a couple days, a couple weeks out, look at hourly charts, look at shorter timeframes and daily charts to really understand that time frame a little bit better. Great questions, you guys, and thanks so much. The questions are getting more and more thoughtful, which is great because I can share hopefully some good wisdom with you and ideas, but boy, it's hard to get through very many of these. We'll get to more of them next week, and keep your questions coming if you could. We need to wrap this show, folks, and go to the 3 in 3. Let's go through 3 charts in 3 minutes. Here we go. Chart number 1 is my S&P market trend model. I review this in detail with my premium subscribers at marketmisbehavior.com every weekend. And what we will be talking about is this continued validation of the downtrend. When things get crazy, when things get volatile, when things get uncertain, at least once or twice a day, I get someone asking me, was that the bottom, based on whatever thing turns a little bit? And my answer is to show them longer term charts like this. This is a great illustration of a rotation from an upward phase in 2021 to a distribution phase in 2022. Every model that I use to track the overall market conditions are still telling me that the trend is going downwards. We may have seen the bottom today. I don't know that for sure, but 380 on the SPYs may be the end. I'm not worried about bottom ticking the market and identifying the actual day when it happens. Overall, I want to be on the right side of things. And I think models like this, long-term models like this, can help you do that more than it won't. Chart number 2, the ARK Innovation ETF. One of my friends, Mark Darriette from Cormark up in Canada, shared this chart with me earlier in the week, hitting the weekly hammer candle last week in the ARK Innovation Fund. His question is, is this the bottom? What's interesting about the chart of the ARKKs, if you look at last week's low, lines up pretty well with the 2020 low, lines up pretty well with the late 2018 low. I don't have a problem with taking a shot like something at ARK, trying to identify if this is a bottom. All I would tell you when you're bottom fishing on a chart like this is make sure your risk is clearly defined. Steve Nissen, who really is credited with bringing candlestick charting from Japan to the West, when I've had a chance to speak with him in years past, he reminded me that one of the key parts of candle charting is that risk is actually built into it. Stop losses are built in. The low of that hammer candle is your exit point. As long as we remain above 35, it's a pretty decent potential opportunity to look for a rise from depressed levels in the ARK Innovation Fund. Finally, the TLT. This choppiness, one of the questions this week was really interesting, talking about, rates going higher. And I think overall, I buy into the higher rate thesis through the course of 2021, just given what the Fed is clearly described their plans to do. However, when people get nervous, they go to defense, and you can't get more defensive than Treasury bonds and even T-bills, which would mean the TLT, the AG, would most likely bounce from here. Might be a really important chart to watch next week. Folks, that's our show and a wrap for this week on The Final Bar. I want to thank you so much for watching our show every weekday after the close. Go to stockchartstv.com for all of our previous great interviews and features. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.